Okay, let's unpack this. What really struck me in our research for today's deep dive and what I found, well, honestly, utterly astonishing, was this. Imagine a French semiconductor company, one deeply entrenched in the cutting edge of 4G and 5G IoT technology, a business built on hardware engineering R&D. Very traditional. Now, picture them suddenly declaring they're raising a significant sum. $200 million. And here's the kicker, the real head scratcher.
Yeah.
It's not for a gleaming new microchip factory
Yeah.
or, to supercharge their next-gen innovation lab. No. They're raising it to deliberately, strategically, and gradually stuff their corporate treasury with Bitcoin. Wait, what? It almost sounds like a plot twist in a financial thriller, doesn't it?
It really does. A venerable chip maker making such a dramatic pivot,
Good.
you wouldn't expect it.
Yeah.
Right. Who would have thought? Well, today, in this deep dive, we're cutting through that noise, pulling back the curtain on this incredible story. We're going to help you understand the bold, almost audacious move by Sequans Communications. Our mission is to explore their aggressive, really unprecedented foray into the crypto space. What it truly signifies for traditional businesses, the ones that have historically shied away from such volatile assets, and the broader implications this has not just for investors, but for the very definition of corporate finance in this digital age. We've distilled insights from a deep stack of sources for you, ranging from the venerable Wall Street Journal to the often insider perspectives of Cointelegraph, NASDAQinvesting.com, and, well, many more, all to give you the clearest, most actionable picture possible.
Exactly. You could almost imagine the boardroom debates, couldn't you? A very traditional, maybe even a bit staid French company suddenly looking at digital gold.
Right.
It's the kind of decision that probably caused a few spilled espressos in Paris, I guess.
Yeah, probably.
But what's truly fascinating here isn't just Sequans' decision itself, though that's big enough. It's how a seemingly niche move by one company, even a significant one like this, actually illustrates a much larger, evolving macro trend. It's something that's fundamentally reshaping how corporate treasuries are managed worldwide. This whole scenario, it begs a critical question for all of us watching this space. Is this a shrewd, forward-thinking financial strategy? Designed to optimize assets in an inflationary world and maybe capitalize on a new economic paradigm? Or are we witnessing a risky bet, something that mirrors past speculative bubbles where, asset holdings overshadow the core business fundamentals? Our job today is to connect the dots, basically, offer you a framework to quickly grasp the why and the what next of corporate crypto treasuries, regardless of where you're coming from on crypto.
So let's get right into the heart of it then. Sequans' $200 million Bitcoin bet. As you said, Sequans Communications is not some fly-by-night startup. They are a French semiconductor company, a deeply traditional, hardware-focused enterprise.
Right. They make chips, physical things.
Exactly. They specialize in cutting-edge 4G and 5G IoT technology.
Yeah.
Think about the physical infrastructure that powers our increasingly connected world. Smart cities, industrial sensors, autonomous vehicles, vast networks of devices all talking to each other. Sequans designed and builds the crucial chips that enable these things to communicate. It's a business built on rigorous engineering, long R&D cycles, and the precise manufacturing of physical products. It's about technical specifications, supply chains, bringing tangible hardware to market. This is about as traditional and tangible as it gets in the tech world.
Absolutely. Real atoms, not just bits. Until now, sort of.
Sort of, yeah. And that context makes their recent financial filing all the more striking. They detailed a plan for a substantial $200 million at the market, or ATM, equity program. Now, for our audience who closely tracks capital markets, the unprecedented aspect here isn't the mechanism itself, the ATM offering. It's the purpose.
Right. ATMs aren't new. Companies use them.
Yeah, exactly. An ATM equity program, just to briefly explain, is basically a way for a company to issue new shares into the public market over time, instead of doing one massive lump sum offering.
Like a slow drip feed of shares.
Perfect analogy. It offers incredible flexibility, lets a company raise capital in smaller increments, maybe daily, reacting to market demand and its own capital needs. It can be less disruptive to the share price than a big secondary offering, maybe more cost-effective too.
Usually for R&D, paying down debt, that sort of thing. Normal business stuff.
Normal business stuff, that's the key. Typically, it's used for operational funding, expanding R&D, paying down debt, or perhaps making strategic acquisitions directly related to their core business, their chip business. But the truly shocking part, the aspect that made headlines across financial and crypto news, was the explicitly stated purpose for these proceeds. According to Sequans filings, the money from this $200 million equity offering is earmarked to fund the gradual acquisition of Bitcoin for its corporate treasury.
Wow. Not hedging, not a small experiment, just buying Bitcoin.
just buying Bitcoin. And they even specified that the timing and volume of these purchases would depend on prevailing market conditions. This isn't about setting up a small exploratory crypto fund. This is about systematically building a significant multi-million-dollar holding of a volatile digital asset as a core component of the corporate treasury. It immediately makes you sit up, take notice, and ask, what exactly are they trying to achieve here?
Indeed. And what's fascinating here is the sheer audacity, right? And the immediate spotlight it cast on Sequels. This wasn't some quiet internal decision. It was everywhere. NASDAQ, Cointelegraph, CoinLive, traditional financial outlets, they all picked it up. It emphasizes just how groundbreaking this felt. And for our listeners who understand market mechanics, an ATM offering, while flexible, also introduces the potential for dilution. That's always the trade-off.
Yeah, that's the key risk for existing shareholders.
Exactly. As new shares are issued, the ownership stake of existing shareholders could be incrementally reduced. So what does it signal when a traditional tech company is willing to trade potential shareholder dilution, something investors usually hate for a substantial Bitcoin treasury?
It signals massive conviction, I guess.
It highlights a calculated risk, definitely. A strong conviction, betting on Bitcoin's long-term appreciation over maybe short-term equity stability or traditional capital allocation. And the technical challenge here, it gets really interesting when you think about the inverse correlation. If Bitcoin dips significantly, they might need to issue more shares to hit their dollar target for buying Bitcoin.
Oof, yeah. Increasing dilution when the stock might also be weak.
Right. It creates this complex dynamic, almost an arbitrage risk, where the timing of share issuance is now directly tied to two volatile markets, their own stock and Bitcoin. This fundamentally deviates from traditional corporate finance, which usually prioritizes predictable capital raises.
And when we talk about significant holdings, they aren't just dipping their toes in the water with this $200 million plan. We learned that they already hold a respectable 3,171 BTC, which, at the time of reporting, was valued at approximately $349 million.
Okay, so they were already in. That's a considerable amount already. Puts them on the map.
Definitely puts them on the map among corporate Bitcoin holders.
Yeah.
But it's their long-term target that truly makes your jaw drop. It makes you realize the sheer scale of their ambition. They aim to accumulate a staggering 100,000 BTC by the year 2030.
100,000 Bitcoin by 2030.
Yeah, that's not merely an investment strategy. That's an aggressive, almost transformative corporate goal.
Transformative is the right word. That's
Yeah.
huge.
This incredibly ambitious target clearly positions Sequans to establish itself as a clear leader among corporate Bitcoin holders, not just globally, but specifically within Europe. They are making a bold statement that they intend to be a major player in this space for the long haul. To put that 100,000 BTC into perspective for you listening, if they achieve this, it would represent a substantial fraction of the total circulating Bitcoin supply. It would instantly place them among the very largest institutional holders worldwide.
No question.
They're effectively signaling a profound reorientation of their financial identity and future value proposition.
Stepping back, this monumental goal, 100,000 BTC, it isn't just an investment. It's a fundamental shift in their corporate identity and asset strategy. To put that into perspective for our audience who follows this space, very few entities, let alone publicly traded companies, hold that much Bitcoin. Maybe a handful.
Right. MicroStrategy, obviously, but few others at that scale.
Exactly. This level of accumulation would make them a truly significant player in the institutional crypto space, not just in Europe, but globally. Sources like Newsfile, A-Invest, Cointelegraph, they all highlighted this incredibly ambitious target. It underscores its prominence in their strategy and investor communications. It suggests they believe the value of Bitcoin will not only appreciate significantly, but will also offer a more robust or attractive financial foundation than traditional cash reserves or other liquid assets, even with the volatility.
Which is the big gamble.
It is. For a semiconductor company, which typically relies on predictable revenue and stable cash flows to fund its long-term R&D, this level of conviction in a volatile asset like Bitcoin fundamentally challenges conventional wisdom. It implies a redefinition of what a stable balance sheet even means in the 21st century.
So naturally, the big undeniable question is why? Right? Why make such a bold move, especially for a company rooted in a traditionally stable, long-term R&D intensive sector like semiconductors? We've delved into what Sequans' CEO has stated directly as the strategic rationale, pulling from sources like the Wall Street Journal, Cointelegraph, and Investing.com. Their stated objectives are clear and, well, quite compelling from a certain viewpoint.
Let's hear them. What's the official line?
First, They explicitly want to optimize their corporate treasury. This isn't just a buzzword, apparently. It implies a belief that Bitcoin, despite its volatility, can serve as a superior store of value or maybe a more performant asset compared to traditional fiat currency holdings.
Especially in an inflationary or low interest rate environment, cash just sits there losing value.
Precisely. The opportunity cost of holding large cash reserves, earning minimal interest, can be significant. Bitcoin offers a potential hedge against that erosion. Second, and this one's really interesting, they aim to increase Bitcoin per share for existing shareholders.
Ah, the Bitcoin per share metric. That's novel.
It is fascinating and, frankly, quite novel. To clarify Bitcoin per share, for you listening, think of it like a new kind of digital book value per share. Unlike earnings per share, which reflects profitability, or traditional book value, assessing assets minus liabilities, Bitcoin per share directly quantifies the pro rata ownership of the company's Bitcoin treasury for each outstanding share.
So total Bitcoin divided by total shares outstanding. Simple enough.
Exactly. If Sequans holds, say, 3,171 BTC and has X number of shares, their Bitcoin per share is 3,171 divided by X. The idea is that as their Bitcoin holdings grow, this specific metric should appreciate, which presumably makes the stock attractive to investors primarily seeking indirect Bitcoin exposure rather than just focusing on the traditional chip business fundamentals. It's a bold way to frame value.
Very bold. A new yardstick for value.
And finally, their ultimate goal, like any corporate move, is to generate long-term shareholder value. They're betting that this aggressive Bitcoin strategy won't just be a supplementary investment, but a key driver of that long-term value, attracting a new class of growth-oriented investors, maybe, and fundamentally enhancing their market capitalization.
That's a profound rationale, it really is, and it forces us to consider the very definition of corporate treasury optimization. When I first read that, I wondered, are we just seeing companies chasing yield in a low-interest world, or is there a genuine philosophical shift happening here?
That's the core question, isn't it?
It raises an important question. Can a volatile asset like Bitcoin truly optimize a treasury in the traditional sense? Traditional treasury management usually prioritizes stability, liquidity, capital preservation.
Volatility is usually the enemy there.
Right. Traditional treasury management screams, no, volatility is the antithesis of stability. However, the new guard might argue that in an inflationary environment, holding cash is actually a guarantee of capital erosion.
A slow bleed.
A slow bleed, exactly. Making Bitcoin, despite its swings, potentially a less risky long-term hedge than traditional fiat if managed with a high-conviction long-term view. It's a calculated gamble on future economic paradigms. And the idea of increasing Bitcoin per share, that's particularly noteworthy. It fundamentally suggests a new metric for shareholder value, shifting focus beyond traditional measures like earnings per share or book value. It's a bold redefinition of what value means for a public company in the digital era.
Well, what about that dilution risk from the ATM? How does that fit?
Well, the equity program, as you mentioned, offers flexibility. Sequans can issue shares when market conditions seem favorable for their stock. That's good. However, this flexibility also introduces market risk for existing shareholders through potential dilution, especially if the share price fluctuates significantly during the issuance period, or, as we said, if the Bitcoin price declines, requiring more shares to be issued to hit their capital target for buying Bitcoin. So, while the stated goals are about optimization and value, there's a really delicate balance to be struck. Capturing Bitcoin's potential upside versus managing the impact on current shareholders and, not distracting from their core chip business.
That truly is the challenge, isn't it? Finding that balance.
Yeah.
But looking at this, does the sheer scale of Sequans' ambition, aiming for 100,000 BTC, somehow change the risk calculation? Does it make them too big to fail in this crypto gamble, or does it just magnify the potential fallout? And zooming out, as you mentioned earlier, Sequans isn't an isolated incident. Here's where it gets really interesting. Sequans isn't alone in this strategic shift towards crypto.
Not at all. It's becoming a trend.
Definitely. They are part of a larger, burgeoning trend that we've been tracking closely. We've observed a diverse range of companies now investing in Bitcoin, spanning various sectors. We mentioned biotech, which we'll touch on again, but also publicly traded mining operations, payment processors, and now significantly, deeply into traditional tech hardware with Sequans. This isn't just a niche phenomenon anymore.
It's broadening out.
And to really drive home the scale of this trend for you listening, consider this striking statistic. Over $98 billion was raised by public companies in 2025 alone with the specific intent of acquiring Bitcoin and drawing investor interest.
$98 billion. in 1 year.
Just for Bitcoin treasuries.
98 billion. That's a massive, almost unprecedented influx of capital specifically channeled into corporate crypto treasuries. You could visualize this. Imagine a financial landscape. Plot the capital raised for corporate Bitcoin holdings over the last 5 years on a chart. The line for 2025 wouldn't just gently rise, it would essentially skyrocket. It would dwarf all previous years combined, like a skyscraper next to modest bungalows. Wow, that's a powerful image.
It paints a clear picture of a financial inflection point. Sources like FinViz, Cointelegraph, CoinLive, the Financial Times, the Wall Street Journal, they've all extensively documented this surge. It signals a widespread and significant shift in corporate financial strategy.
That's an excellent point, and it's where the comparison to MicroStrategy becomes both illuminating and maybe a bit cautionary. The sheer scale does change the game, but whether it mitigates or magnifies risk, that's the billion-dollar question, or maybe the 100,000 Bitcoin question here.
Yeah.
This data you described, that $98 billion, it signals a sea change in corporate finance. It shows Bitcoin moving beyond a niche interest to a more mainstream, still heavily debated corporate asset. This widespread interest has profound implications. For one, it offers a powerful validation for Bitcoin as a legitimate store of value or growth asset, at least in the eyes of more traditional institutions and boards.
It lends it credibility.
It does. And secondly, it plays directly into investor attraction. Companies are recognizing that having Bitcoin on their balance sheet can, at least initially, make them more appealing to a certain segment of the investment community, particularly those bullish on digital assets or seeking a hedge against traditional market uncertainties. This creates a fascinating dynamic where corporate strategy isn't just about improving the core business anymore, but also about signaling alignment with a rapidly evolving digital economy. It suggests a strategic rethinking of capital allocation in a world where traditional assets might not offer the same growth potential or inflation protection.
But, okay, not everyone is cheering this trend on, and it's crucial for us to acknowledge that counter-narrative. There's a healthy dose of skepticism from critics.
Oh, absolutely, and rightly so in some ways.
The Wall Street Journal, among others, has extensively reported on warnings from financial analysts and economists. They see this trend mirroring past speculative bubbles. They specifically draw some unsettling parallels to the SPACman mania of recent years. Remember that?
Oh yeah, the blank check boom and bust.
Exactly. Where special purpose acquisition companies were all the rage, often leading to overvalued companies with minimal operational history and eventually significant losses for investors when the hype just evaporated. The concern here is that a similar dynamic could be at play with corporate Bitcoin adoption.
History repeating, potentially?
Potentially. These critics raise serious concerns about possibly unsustainable business models that might be driven primarily by the perceived value of crypto holdings rather than robust revenue-generating core operations. The worry is that some companies might be using Bitcoin investments as a way to generate excitement, inflate stock prices, attract speculative capital, instead of focusing on the fundamentals of their actual business, their product, their profitability.
Right. Are they becoming essentially Bitcoin ETFs with an operating business tacked on as a side hustle?
That's the fear, rather than genuine innovators in their respective fields.
And what's truly fascinating here is the historical context that critics are drawing upon. They are rightly pointing to moments in financial history when asset speculation completely overshadowed fundamental business strategy. Beyond the SPAC mania, critics also draw unsettling parallels to the dot-com bubble of the late 90s. Remember companies with basically no revenue but an internet strategy commanding astronomical valuations?
Oh, vividly. GeoCity stock, anyone.
Exactly. The core question now is a Bitcoin strategy risking a similar misallocation of capital? Consider a hypothetical company, Innovator Inc. Their stock soars 200% after announcing a big Bitcoin buy. But without a corresponding improvement in their core revenue or product pipeline, that enthusiasm eventually evaporates.
The sugar rush wears off. It wears off, then Bitcoin corrects, maybe their Q3 earnings disappoint, and boom, the stock tumbles well below pre-announcement levels, leaving a lot of investors holding the bag. This highlights a fundamental concern. Are companies becoming overly reliant on Bitcoin's price appreciation to mask deficiencies or lack of growth in their primary business? It's crucial for investors, for everyone listening, to consider these different viewpoints. Weigh the potential for innovation against the very real risk of speculation and distraction. Understanding these criticisms is just as important as understanding the bullish arguments. True insight comes from that balanced perspective. #tag lessons from precedents and reality checks.
Absolutely, expert. It's about having that balanced perspective and definitely understanding history. So let's look at some real-world precedents and what they might teach us. This offers a crucial reality check to this whole phenomenon. When we talk about companies making huge Bitcoin bets, the prime precedent, the one that essentially wrote the blueprint for this corporate strategy, is MicroStrategy.
Right.
The OG of corporate Bitcoin, Michael
Yeah.
Saylor.
Michael Saylor. They effectively transformed their identity from a relatively niche software analytics company into what many now overtly call a Bitcoin proxy. MicroStrategy went all in, leveraging various financial instruments, convertible notes, debt issuances to acquire vast amounts of Bitcoin, accumulating a truly staggering sum over time. The reported outcome for them, especially during bull market cycles, was that they reaped massive investor returns from this audacious strategy. They really became the poster child for corporate Bitcoin adoption.
It absolutely did.
They demonstrated that a public company could successfully reorient its entire market perception around a digital asset. They showed that for a certain segment of investors, this strategy could be incredibly lucrative. It acted almost like an accessible, regulated way to gain exposure to Bitcoin.
And if we connect this to the bigger picture, Sequans is clearly looking at that playbook. They seem to be trying to follow a similar path, but they are applying this model to a different, broader sector.
Moving beyond software.
Right. MicroStrategy started as software analytics. Now, Sequans is bringing this into tech hardware, specifically semiconductors. This suggests a diversification of the Bitcoin proxy model itself across industries. And what it means for a company to become a Bitcoin proxy is that a significant chunk of its stock performance becomes highly correlated with the price of Bitcoin, sometimes almost one-to-one.
So the stock basically trades like Bitcoin, but with extra steps.
Kinda, yeah. For investors who want Bitcoin exposure but prefer investing through regulated public equities, a company like MicroStrategy, and now potentially Sequans, offers an attractive, albeit indirect, avenue. It simplifies access for institutional funds or individuals who maybe can't or prefer not to hold Bitcoin directly due to regulatory hurdles or custody concerns. This also implies a deep, long-term conviction from these companies. They believe Bitcoin will not only appreciate, but will fundamentally outperform traditional assets over the coming years.
But MicroStrategy's ride wasn't smooth either, right?
Not at all. Their journey involved periods of extreme volatility. There were times when its stock saw massive drawdowns right alongside Bitcoin's corrections. Sequins will inevitably face similar pressures, absolutely. How they navigate those downturns will be critical.
And it's not just software companies or semiconductor makers embracing this. We've seen this trend expand into other, sometimes surprising, sectors, further underscoring its growing mainstream appeal. We have further examples, as we touched on, of companies adopting this trend in the biotech space, for instance. Firms like Hoth Therapeutics and Life Sciences previously added Bitcoin to their holdings.
Right, biotech, not the first place you'd look for crypto adoption.
It's exactly. Hoth Therapeutics, a biopharmaceutical company, announced it had purchased Bitcoin, citing its potential as a long-term investment and a hedge against inflation. Life Sciences, another clinical-stage biopharma company, similarly incorporated Bitcoin into its treasury, viewing it as a strategic asset to diversify holdings and potentially generate additional liquidity. These moves show that this wasn't just a tech-centric phenomenon, but a broader financial strategy being considered even in highly regulated, research-heavy industries.
And what's fascinating here is that Sequans' move really expands this trend beyond the early high-profile adopters like MicroStrategy and even beyond the somewhat unexpected biotech sector. It brings it squarely into the traditional tech hardware sector. This indicates a wider acceptance and exploration of Bitcoin as a corporate asset across increasingly diverse industries and management teams. It suggests that the perceived benefits, whether as an inflation hedge, a store of value, or a growth asset, are resonating with management teams outside of just crypto-native businesses or software-centric firms.
It's spreading.
It's spreading. This broadens the conversation significantly. It demonstrates that the appeal of Bitcoin on a corporate balance sheet isn't confined to one type of industry, but rather a more generalized financial strategy being considered across the economic spectrum, albeit, with varying degrees of scale and conviction.
Yeah, good point. Hoth and Attai's holdings were notable, but definitely smaller scale compared to MicroStrategy's accumulation or Sequans' massive long-term target.
Exactly. Different levels of commitment.
Now, for the critical question, and this is a crucial reality check that ties back to those concerns about speculative bubbles, what about the actual stock performance of companies making these flashy crypto headlines?
Ah, yes. The rubber meets the road moment.
Exactly. The Wall Street Journal, alongside sources like UFINS, A-Invest, CoinGecko, and FinViz, has reported on this extensively. The common pattern observed is that many companies initially saw significant stock jumps immediately following their crypto-related announcements.
The announcement pump.
The announcement pump, precisely. That initial burst of investor excitement, often fueled by headlines, social media buzz, the perception of aligning with a rapidly growing asset class. However, and this is the crucial part for long-term investors, these initial surges were often followed by declines. This leads to serious questions about the long-term sustainability and true value creation of these crypto-motivated corporate moves.
So the pump doesn't last.
Often, it seems not. Sources like Ilmium, NASDAQ, Stock Titan, they've also reported on this pattern. Imagine a stock chart. You see a sharp, almost vertical line upward right after the Bitcoin announcement, only to be followed by a gradual or sometimes even steep decline over the subsequent months, often bringing the stock back down to or even below its pre-announcement levels.
Ouch. Round trip to nowhere, or worse.
Right. It suggests that while the market might react positively to the news in the short term, sustained value requires more than just holding Bitcoin. It demands continued strong performance from the core business, robust earnings, clear operational success. The initial crypto bump often serves as a temporary sugar rush, which eventually wears off if the underlying business fundamentals don't support it.
That's a vital distinction, host, for anyone watching these trends. And it really reinforces the critical perspectives we discussed earlier. While we don't have a specific real-time Sequans stock impact chart to analyze their post-announcement performance in detail just yet, the data from the Wall Street Journal and others suggests that initial investor enthusiasm, often driven by the novelty or excitement of crypto exposure, can frequently be fleeting. This raises an important question again. Is the market ultimately valuing the underlying business's fundamentals and operational success, or is it merely reacting to the crypto exposure?
The signal versus the noise.
Exactly. It's so important for investors to look beyond the initial headline surge, understand the long-term financial health and strategy of the company. A company adding Bitcoin might see a temporary boost, sure. But if its core business isn't strong, if revenues are declining, or if the Bitcoin price itself corrects significantly, that initial boost can quickly erode. The true test of this strategy lies in sustained, long-term shareholder value, not just a momentary pop based on a press release. It's about fundamental strength, not just speculative appeal. #tag deep dive into the why and what next.
That distinction between short-term hype and long-term value is absolutely crucial. So let's dive even deeper into the why and what next of all this. For crypto investors especially, this story holds a lot of weight. Sequans' strategy exemplifies how traditional firms are beginning to leverage Bitcoin not just for simple exposure, but as a genuine strategic asset within their corporate structure.
That's the key phrase, strategic asset.
Right. It's moving beyond just, we own some crypto, to this is an integral engineered part of our financial plan. This approach, well, it has the potential for a broader impact. It could genuinely normalize corporate crypto treasuries as a standard practice in the business world, similar to how companies hold gold or foreign currencies or other commodities as part of their treasury diversification strategy.
Making it just another tool in the toolbox.
Potentially. However, we absolutely cannot ignore the critical risks involved. We've mentioned the potential for dilution for existing shareholders through these ATM offerings, which can impact earnings per share and overall ownership percentages. Then there's the inherent volatility of Bitcoin itself. It can swing wildly, unpredictably, impacting the reported value of their treasury assets almost daily.
Huge swings can make balance sheets look crazy quarter to quarter.
Exactly. And then there's the ever-present shadow of evolving regulatory scrutiny. Regulators around the world, particularly in the EU and France, where Sequans is based, are still grappling with how to classify, govern, and account for digital assets. That adds another significant layer of uncertainty and potential compliance burden.
A big question mark hanging over everything.
A huge one. How they navigate these external pressures will be just as vital as their internal strategy.
And what's truly fascinating here, host, is that subtle but crucial difference you highlighted between exposure and strategic asset. Exposure implies a passive holding, right? Almost like a side bet, a small diversification play. Strategic asset, however, suggests deep integration into broader financial planning, potentially influencing capital allocation decisions, risk management frameworks, maybe even operational considerations down the line.
It's more active, more integrated.
Exactly. For our audience, you could visualize a financial pipeline. a funds flow diagram, if you will. Capital flows in from new share issuance via the ATM program, then through a deliberate conversion process into Bitcoin, which then influences that Bitcoin per share metric you described earlier.
It's deliberate financial
It
engineering.
is almost a retooling of their capital structure. This is a significant shift that demands both attention and careful consideration of its long-term consequences. However, this also raises an important question. Can a traditional semiconductor company truly navigate the complexities of Bitcoin's volatility, manage the security risk of holding such a large digital asset that's non-trivial, and anticipate the evolving regulatory landscape without it becoming a significant distraction?
The distraction from their core business of making chips.
Right. The tension between innovation in their core hardware business and innovation in their treasury management, it's palpable. You have to wonder where the focus will ultimately lie.
And to really put Sequans' ambition into perspective, it's incredibly helpful to benchmark their corporate Bitcoin holdings against others in the market. This helps us understand just how monumental their goal of 100,000 BTC truly is.
Yeah, context is everything here.
For example, a key comparative example in Europe is Bitcoin Group SE. They're a German company whose core business is explicitly focused on cryptocurrencies and blockchain tech.
So they're a crypto native, essentially.
Pretty much. They hold approximately 12,387 BTC. Now contrast that with Sequans' current holding of around 3,171 BTC.
Okay, so Sequans is significantly smaller right now compared to a dedicated crypto player like Bitcoin Group SE.
Right. So while Sequans already has a respectable amount, they are still a ways off from some of the existing large corporate holders, especially those whose primary business is crypto. And then you have the giants like MicroStrategy holding hundreds of thousands of Bitcoin, or even Tesla, which at one point had significant holdings.
But if we connect this to the bigger picture, Sequans' projected growth to 100,000 BTC by 2030, that is truly monumental. When you compare that projected number to Bitcoin Group SE's current holdings, substantial. But from a crypto-native company, you realize the sheer scale of Sequans' ambition coming from a hardware manufacturer. It's a different stratosphere.
It really is.
This raises an important question about the long-term impact on their balance sheet, their overall risk profile, and even their stock valuation. They are aiming to transform effectively from a hardware company with some Bitcoin to a major Bitcoin holder that also happens to have a hardware business.
The emphasis shifts completely.
Completely. This kind of transformation fundamentally alters investor perception and the company's financial structure. It demands a reevaluation of how we assess its value and future prospects. It's not just about a large investment, it's about a fundamental reorientation of their identity in the market. They're becoming this hybrid entity, marrying traditional tech with a significant digital asset strategy. How the market ultimately prices this dual identity. That will be one of the most intriguing financial stories to watch over the next few years, for sure. Hashtag listener engagement and concluding thoughts.
So, expert, after all that, what does this mean for you, the person listening right now? Whether you're tracking the tech sector, navigating the crypto market, or just generally curious about where corporate finance is headed. What should you take away? We've unpacked a lot of information today, from a French chipmaker's incredibly bold bet to the broader corporate adoption trend, and crucially, the critical perspectives that provide that necessary balance to all the excitement. Now, we want you to consider these questions for yourself to really internalize the insights we've shared.
Absolutely. Really think about these. First, would you personally buy stock in a chipmaker that plans to hold Bitcoin at this kind of scale? Do you fundamentally see it as smart diversification, a visionary, forward-thinking move in an uncertain economic climate? Or do you see it as a risky distraction from their core competency that could ultimately jeopardize shareholder value? Where do you land on that?
Good question. What's your gut feel?
Second, when you consider these companies, which do you believe is ultimately more valuable to shareholders in the long run? Is it the direct Bitcoin exposure on the balance sheet, or is it traditional business growth focused intently on their core product, innovation, and market leadership in their original sector? Which path creates more sustainable value?
Bitcoin booster or a better business?
Yeah, basically. And finally, considering all we've discussed today, the precedents like MicroStrategy, the rationales, the criticisms, the risks, do you believe corporate Bitcoin treasuries are truly on their way to becoming a new norm for businesses, a standard practice for managing capital in the digital age? Or are we instead heading into another speculative bubble that might just burst and leave some companies dangerously exposed? What does history suggest?
That's a lot to chew on, isn't it? And it really forces us to think about how we define value, strategy, and even prudence in today's rapidly evolving markets. So just to recap our key insights quickly, we've explored Sequans' bold $200 million move to fund a Bitcoin treasury, positioning themselves for that massive 100,000 BTC target by 2030. We've seen how they're part of a growing wave of corporate Bitcoin adoption, following strategic rationales that echo precedents like MicroStrategy. But crucially, we've also highlighted the important criticisms and risks involved, from potential shareholder dilution and market volatility to the ever-present shadow of regulatory uncertainty.
Can't forget those risks.
Never. Understanding these complex dynamics is absolutely key to being well-informed in today's rapidly changing financial and technological landscapes.
And this raises, I think, an important final question for all of us watching this unfold. As the lines between traditional industry and digital assets continue to blur, how will we, as investors, analysts, observers, how will we truly define value and strategy in a company going forward? The Sequans story, maybe more than most right now, forces us to reconsider the very fundamentals. What constitutes a robust, forward-looking, and ultimately successful corporate financial strategy in the 21st century? It's a testament to the fact that the old playbooks are being rewritten right before our eyes.
Well said. And if this deep dive has given you clarity on why companies like Sequans are stacking Bitcoin, if it helped you understand the real-world impact of these crypto moves and clarified the broader trends reshaping corporate finance, then please do us a huge favor. Like this video, subscribe to our channel, and definitely hit that notification bell so you don't miss our next deep dive. Your engagement, your likes, comments, subscriptions, it really helps support our mission to break down these complex topics. It boosts our visibility in the algorithm so more people like you can find this analysis. And honestly, it allows us to keep creating quality content that helps you stay informed and make sense of these incredible shifts. We really appreciate your support. It makes a huge difference.
It really does. Thanks, everyone.
Until next time, keep digging, keep learning,
And keep thinking critically.